Carl, good to see you as always. Thank you for
Likewise.
coming to have a chat with us. You're involved with a really interesting thing, certainly to a lot of the people I talk to, because you're involved with an investor network. And lots of the entrepreneurs that I speak to, for obvious reasons, are interested in understanding better how investors see things. So thank you for giving us a bit of time. I know you're pretty busy at the moment, but I really appreciate you coming to talk to us about the kind of investor perspective on global growth. So, just to kick off, tell us a bit about yourself and a little bit about the Harvard Business School Alumni Angel Network. Did I get that right? Just tell
Yeah,
us about them.
sure. So I'll give one line on me, and then I'll talk about that role that I'm in now. So the headline I give, as I say, I've got 25 years experience in the impact space. First as an executive at Johnson & Johnson, leading business transformation and doing some exits. Then as an advisor working for then Prince Charles in sustainability space, advising companies on how to create value by living their value. So as an advisor. So leading transformation, advising on transformation, now investing in transformation, the impact space. That's been the last leg of my career. For me, that's mainly been health tech, climate tech. And for me, impact is any company that really has a net positive impact on people, planet, and our prosperity. So that's kind of my filter. So along the way, I've founded, funded, scaled, and exited multiple businesses, been able to lead 7, 8, 9 figure operations. And now I work with founders to help them along that journey. So one of the things and along the way, I raised about 150 million for these different impact ventures and things like that. One of the roles that I ended up in along the way was being a member of the Harvard Business Angels of the UK. So we've got a UK club. We've got 20 chapters globally. I'm now co-chair of the UK club, and I chair our deal screening kind of a quasi-investment committee operations committee of about 12 of us who really we source deals and then we screen them and see which ones we want to invite our angels to invest in. And so and just to give a headline on the Harvard Angels. So globally, the 20 chapters have invested over $100 million in various companies. We've got
Wow.
chapters in Boston, as you'd expect, New York, Northern, Southern California, and then globally. And London chapter, we've made around about 60 investments in the last 12 years. And we've had several noteworthy exits, including like a 2 billion exit to private equity, and then a 385 million IPO here in the UK, which was Pension We've had several other 9 figure exits and 8 and 9 figure exits to Apple and Prudential. So we've had pretty good success. So that's kind of one of the roles that I'm in. I have my own firm now, which is an advisory media business, where I support founders and basically helping them simplify complexity to get the confidence they need to lead their companies lead their companies and grow. So that's me, my day job, and then one of my other roles is this Harvard board, and I'm a board member there and chairing that committee. Now, I will say the rest of my comments for today. I've been an investor myself for a number of years, so the comments I'm making today, it's an approach I bring to my chair position there. However, it's not the official canonical role of the Harvard overall club. It's kind of more Carl's view of the world as a co-chair of one of the chapters, and me as an individual.
Sure. So, I mean, you touched on this model that you've developed, which when you described it to me, I thought, I mean, it's a really interesting and helpful way to think about the investment process. So, just to kick things off, I mean, talk us through. We'll come back to how you developed it later on, but just talk us through this 5+1 structure. In simple terms, so that from the point of view of an entrepreneur, they can see what the sorts of things that are within scope, if you like, when you
Sure.
think about making an investment.
Yeah. So for me, it's these are the factors that I look for personally as an investor, and like I said, as I talk about that, I didn't invent all aspects of this model, but I kind of pulled from colleagues and what I see in the industry. This has been road tested over the last at least 10 years plus in terms of active investment activity things. So, but it's 5+1. So what do we look for? So I'm big on the team. However, uh, my colleagues and I would debate it, and basically, timing is really important. As well, you have the right idea at the wrong time, you get pain, no matter how great the team is. Sometimes you maybe a different idea. So we look at what's the big idea. So the first thing is kind of what's the big idea. For example, is it a large and growing market? Why now? You got what are the tailwinds rather than headwinds, that sort of thing. And then the second factor is the team. Is this the right team to deliver this business plan? The third element is proof of concept, and that breaks out into two dimensions: product proof of concept. Does the product work? And commercial proof of concept. Does anyone want to buy it? Fourth area is how you scale and protect the business. This could be intellectual property, partnerships, that sort of thing. And the fifth category is around the exit, valuation, and other terms, and any other investors who are involved. And then the plus one for me is the impact. What is the overall impact? How will the world be a better place and transformed by virtue of this company being in existence?
Okay, so let's look in a little bit more detail about those areas. So the team bit, just I mean, lots of investors say what I look for is a great team. It's very easy to say. It's much more difficult to work out what a great team is, isn't it? I mean, tell us about your kind of mental model for working out what a good team looks like.
Sure. I'll give a couple of headlines, then I'll go back to the kind of the idea and the timing
Yeah.
thing, if that's all right for the section. So what I look for, yeah, it's everyone, we all talk about the team, right? So, okay, I've got a framework for it. And then also there's a headline in terms of heuristically, what do we like to see, right? It's easiest for us to invest, for me and for us to invest in companies where it's a successful serial founder, second, third, fourth, fifth,
Okay.
go at it. They've made money for their investors each time because and our data, we've got data across our chapter shows that if the founder is at least a second time founder and their investors made money each time, then they're statistically slightly higher to be more successful.
Yeah.
So that's one factor. And then also, right, if they're a big name, if they're bringing other investors with them, I've had other founders that we worked with who they're 5 or 7 times successful founders, and every time they just bring their own investors and momentum with them, so it's very easy to follow on there. Okay, so if you've done it before with startup scale-up experience and exit experience, the team together has that expertise and capability. Now, in terms of the roles, what I like to see, and these are roles, not necessarily people, but the aspects I like to see in an early stage business is 3 essential roles you have to cover. One is you need the visionary. Where is this business going? You need a product person who actually can engineer that, and then you need a salesperson, right? Now, sometimes if you're a solo founder, those all 3 things you can wear all 3 hats. Now, incidentally, that's one of our negatives, which is if you are a solo founder, we know it's hard work starting and running and scaling a company. So if you're a solo founder, it's seen as a single point of failure. It's a big risk. I know investors who just won't invest. I know investors who withdrawn their money when they found out that there was a solo founder, for example. So that's tough. But so those are the 3 roles. And then as the company grows a bit, you like to see, within that, someone obviously has their head around the numbers, and then a mentor, advisor, board advisor, someone who can come in and help guide and steer that team. But in the early days, it's those 3 roles. Who's the visionary? What is the vision for this business? What are you trying to achieve? The product engineer person who's not going to get there, and then the salesperson who can take it to market.
Sure. And to come back to your last point there about taking it to market, I mean, the other thing that you look for is a really great idea.
Yeah,
Now,
yeah.
I mean, again, it's very easy to say it's a great idea. How do you work out what is a great idea and isn't a great idea? I mean, just talk us through your kind of take on that.
Yeah, yeah, and I will say we're a little spoiled in the UK, okay? Because we like as much proof of concept as we can get,
Yeah.
right? We like the product to already be, we already like an MVP or beyond out there. We like as much traction, sales revenue as we can get or proxies thereof. So the best way to demonstrate that you're onto something, onto good ideas, you have customers who are telling you that it is a good
Yeah.
idea,
Yeah.
right? That's the best way. And so we had our pitch event last night. We had 4 companies come, and I'll tell you about the team in a minute. One of them had a phenomenal team in particular, and 2 million revenue after like 8 months, and they were just off. They already had a 40 to 42 million buyout offer, and they turned it down because
Wow.
they're riding the rocket ship. Okay, I can tell you what was so fantastic about that team, but don't want to lose my train of thought on that. But so the best way to show it is that you're already doing it, and now what we need to balance that with as angels is we also like an angel friendly valuation. So those are the 2 forces. So for early stage companies, I would say basically either have sales or proxies for demand, surveys or letters of intent, pre-sales pulled forward. Try to pull as much of the evidence of that forward so that it's not just your opinion. And the other thing we like for the one company that already got the 42 million offer after like 8 months, they hit 1.5 million revenue in 6 months. They're solving a problem that they saw firsthand from their prior corporate lives, and now they're coming in and creating a solution for that because it was a prop tech company, and they're all kind of some of the big PE firms and accounting firms and consulting firms and investment banks. So they've seen there's this unmet need in the investment market for private investors, not big institutions, to be able to find the best real estate deals. So they basically created a mini BlackRock, Blackstone that B2C you and I could use. And it's like instead of a team of 100 analysts, they've got this AI tool and all this proprietary data that they use to help you find the best investment opportunities. So they spotted a gap in the market, and now they're closing it. And through word of mouth, they're just it's on fire.
Sure. So,
And they're yeah,
well, I was saying, so a great product, a great proposition, a great team, and those. I mean, I certainly get the logic of those two. Tell us about the other components to your framework as well, because they're probably they're they're not as big as the first two, it seems to me, but there's a level of importance to all of those other components. Just talk us through the other components.
yeah. So okay. So let me come back to the timing and whatnot, because certain we'll know this, right? But certain markets are in downturn, like secular downturn, and from a like let me give a window into investor mindset. Angels for tech startups, angel investors that hope to have a VC follow-on round for the company they invest in. Why do we talk about the market and the market size in particular? One of the parameters to bear in mind is how VCs think about which investments they make. So if you're a venture capital firm funding, you've got a £100 million fund, you hope that you have a finite number of investments in that fund. You would hope that you're making bets on a company that could potentially return the whole fund, right?
Yeah.
So what does that mean? So the headline is this. For us, a VC-friendly market size is one that's at least a billion, in the billions, and it's growing. If you got double-digit growth rate, or 8, 10, 12% growth a year, that's great, because there could be a lot of winners in a market like that,
Yeah.
right? And so just to go further with the math, so let's say, just using round numbers, I'm a VC, I've got a 100 million fund. I'm going to make a 10 million investment in a company. In order for that investment to return my whole fund, I need at least a 10x, right? So then, let's say I put 10 million in, and when the company exits, I own 10% stake, right? So, and then if I make a 10x, I need to make 100 million on that, and I own 10%. So then the company needs to be worth a billion in order for 10% of that to be worth 100 million for me to return my whole fund. So therefore, we've rejected companies that had a 250, 280 million market size who said too small, too small. So that's one of the considerations for venture and tech companies in particular. Angels will invest in lots of businesses, but that's one of the so what's behind why you need such a big market size. That's why.
Yeah. Yeah.
And so that's one thing.
Yeah, go on, carry on. Sorry.
So there's that for the market sizing, and then in terms of the other elements, so there's that the team we talked a bit about, and Paul, we will come back to the negatives, right? We're going to go through the positives, what we want, what we don't like to see, right? And then on the proof of concept, there's a product proof of concept and commercial proof of concept. So we as an angel group, and me, I focus on health tech and climate tech, but we as an angel group are sector agnostic. And even if you do health tech and climate tech, you will see some typical software, highly scalable businesses, and then you'll see some deeper J-curve R&D based companies that work more with molecules rather than, so work more with atoms and molecules rather than electrons, right? Software is electron scalable, but a lot of the challenging problems like climate change and others that the world faces are going to be solved by companies that focus on atoms and molecules. So they tend to be deeper J-curve businesses because you have form factors. You've got more challenges. Developing software is a more controlled process than putting rockets into space or doing R&D research in a biotech lab. Different risk profile. So getting a bit more color on this. So the product proof of concept for a software business, you have one MVP, early revenue is great. And then for a deeper J-curve business, like we had companies last night, that's one company's trying to tackle antimicrobial resistance. And that's a big cause of infection and death in hospitals, secondary infection and cause of death in hospitals for people who use medical devices. Ventilation tubes and catheters and all kinds of things. Big problem. Billions of those pieces of equipment are used every year, and there's a huge infection risk. So that company there, companies like that in medtech companies sometimes can be sold for 9 figures pre-revenue. So how do you assess them? What does proof of concept look like for that company? Because healthcare plays tend to be moonshots, $150 billion markets, whatever. So there we're looking for, okay, what are you in side-by-side lab tests? Are you performing better than the main technology that's out there? Are you broader spectrum? Can you cover all bacteria and microbes, whereas the current leading tech can only cover half? And or are you more precise in how you do that? And if you're showing that, even you may be pre-revenue, you may be in certain clinical trials, you can get licensing agreements, pre-revenue, and before your clinical trials finish, you can get licensing agreements that will pay out on milestones as you get those different regulatory approvals. So for us as angels, we had companies come through, we'll look at them too. So it's different sort of, it's like horses for courses. And I make sure the committee with kind of one of my roles is to make sure we're comparing apples to apples. We don't compare a typical highly scalable software business with a deep J curve business in terms of stage.
No.
And similarly for the commercial proof of concept, it's easier for B2C companies, it can be, for them to have early revenues with an app, right? So that's one thing. If you're B2B, if you're doing enterprise sales, it can be lumpy, right? Even the way you value, we'll get to this later, but the way you value an enterprise SaaS business is different than the way you value typical B2C sort of SaaS business. As the enterprise SaaS business is going to have lumpy sales, maybe 6, 12, 18 month sales cycles. So they're going to have no sales, boom, and then a big one, and it could be lumpy. So how do you value that versus, let's look at the month-on-month growth rate, which is a typical way that they value SaaS business. So I'll pause there in terms of what we look for proof of concept. So I can come in for the next part, if you like, around how you scale and protect it. The fourth part.
Talk about that.
So that relates, picking up on what I mentioned before, how you scale and protect the business. Warren Buffett, always loves companies that have big moats, right? And for us, so we look at how you scale and protect the business. We're looking at intellectual property, can be patents, can be trade secrets, know-how, and then relationships, industry partnerships, audience, the kind of network externalities, all that stuff, that kind of network effects. All those things are defensibility, because we want to know as an investor, how far and how long does this business have to run before they get some serious competition, for example. Because if you need that $1 billion exit, let's say, then the company has to have some special secret sauce and needs to be able to operate for a certain amount of time if it's a revenue play. Whereas if it's a deep tech, med tech play, it just has to add enough value in the eye of that strategic acquirer, where they can take that tech and dump it into their distribution network, and boom, all of a sudden they have a multiple on their whole company if they're a big multi-billion multinational. So those things are really important. Those can really differentiate you. We as angels, particularly for tech heavy investments, we like to see what's the uniqueness, what's the defensibility. Defensibility is a big thing, and there's always the question now that we always get in software businesses: is what's preventing Google or Microsoft or Meta or OpenAI from doing what you're trying to do?
Yeah.
How are you just plugging into their APIs? What's actually unique about your data set? That's hard for others to replicate. One of the companies last night was pre-revenue, but they did a 2-year trial in multiple hospitals with patients using their technology for self-management of Parkinson's. And they learned so much from that. And one of the things they mentioned would be, in general, the cost to replicate what they've developed in terms of time and money. So there's that. And then, like I mentioned, alluded to, the commercial partnerships. One of the companies from last night is close to inking a licensing deal with one of the biggest medtech companies out there. And that will be a kind of co-marketing and licensing selling deal. And once they're already selling into the sales reps of individual equipment manufacturers, but once they get the corporate-wide level licensing globally, they're going to be off to the races. They already have $500,000 in ARR. They're selling software that helps brain surgeons choose the right stents to implant. Okay?
Wow.
Yeah. And so they're selling that into the Medtronic Stryker sales reps, because it makes those products safer. So they're going into they've got clinical evidence in the hospitals, and then they're selling it to the sales reps of those companies. However, they're looking for big licensing deals. Once they already got EU and UK clinical approval, they're looking to get FDA approval. Once they have that, they can sign the licensing agreement as a global partner with this big player, and boom, then they're off. So then they really can realize the value of the solution on a global stage. So that sort of partnership, having that in the wings and telling us you're X months away from that, and that our money's going to help fund that, it's like having pent up demands. Okay, we love that.
Yeah.
And then, so in terms of exits and evaluation, and one other thing we love is simple deal terms. And if you've already got tier 1 venture capital funds in the cap table or in the deal, it's very easy for us to follow on. We'll get companies that already have seed investment from Atomico or whatever. Very easy for our angels to follow on, because we kind of trust that level of due diligence and that sort of thing. And then from our perspective, from an exits perspective, we like companies that are already thinking of optionality, because we know the IPO market's been clogged up for a while, for years. So then what's your optionality? Can you sell to a strategic player, financial player? What are the options? Like one of the companies from last night had 300 licensing options. So even if they don't get a few of them, they've got way more chances to make it work. So does that make sense?
Yeah. So you touched on that we need to think about some of the negatives, the flip side to what you've been talking about. I mean, just talk us through that. I'm particularly interested in how investors perceive risk.
Mm.
How do they think about risk, and what should entrepreneurs be cognizant of? Just talk us through that, the flip side to what you've been talking about.
Yeah. So we do. It's me as an operator, a fellow operator, current operator, and investor. I have a soft spot for founders because we do just stack up the risks, right? We just look at operational risk, regulatory risk, financial risk, geopolitical risk, funding risk. We just stack it all up, right? So what I would say, and I do say to founders, I do a lot of coaching as they pitch us. I say, hold on, we like this. Keep ABC, please. Add XYZ and remove, this D thing. Um, what we see as risk is you don't have that proof of concept. Like the form factor isn't, you don't have a minimum viable product, or you've not really you've not been able to sell it yet for whatever reason, or you've only sold one in a few years. Not great, right? That's the other thing. You're going to be when you're pre-revenue, you're going to be judged on your plan. Once you're post-revenue, you're judged on your actuals.
Yeah.
And so people are buying the narrative in the early stage, and I've seen companies have trouble fundraising when they do well in the first year or two, and then they go out to fundraise and their sales plateau for whatever reason. And you must hit your targets during the capital raising period. If you're doing a 6 or 12 month cap raise and you tell investors in 3 months you're going to be here, and then they check in 3 months and you're not there, you're toast. So but in terms of what we see as risk, so single founder, not a large enough growing market, a team that's not well-rounded, doesn't have those three roles covered, doesn't have the scaling experience, and or it's okay at an early stage, but when they haven't earmarked who's going to join the team, right? Uh, Subject to geopolitical risk. So, for example, if there's a new administration comes in their country, one administration's really pro-green, another administration's not. Is that money? How dependent is your business model on grants and subsidies and all that sort of stuff?
Yeah.
And then a big one for us is jurisdictional risk. Where's the company headquartered? Can we due diligence it effectively? So we like companies that have global aspirations and ambitions. We do like those where we can go see the HQ and the founding team, get eyes on them. And actually, incidentally, one of the companies last night, the really most impressive one in terms of that had the most traction and most momentum. They said, Karl, we're getting some unusual, interesting requests. They're oversubscribed. They're doing a 5 million round at a 25 million valuation. Chunky for angels, but we let them in because they're so impressive. They're oversubscribed. They've already got 10 million soft committed, so they're going to pick and choose. But they said one of the angels came and said, we want to come and just observe you guys working for the day. Can we do that? He said, yeah. So the angels came in, just sat, not our angels, but some other angels. Yeah, it's part of the round. Just came in and sat in the back of the room and watched them. And at the end of the day, they come up and said, we're in. Right. Yeah. So that's a sort of a window on the world, like de-risk it a bit, right? So one of the things that we do is if you're a board advisor, or if you have a strong network of board advisors, they get that hands-on view of what are the strengths and weaknesses or liabilities or allowable weaknesses of the different founders and teams beyond, because they don't have public financials. They don't have 3 years audited actuals in the early stage. So how do you actually figure out who's backbone, who's not? So there's that. Then, yeah, the defensibility is a big one. We see that as a huge risk. For example, we'll say, okay, why is this the team that's going to win in this space? Or is the market growing enough that there'll be multiple winners? But if we sense during the pitch or the screening process with the other team members that we don't get a straight answer, or they don't understand the numbers, whatever, we're thinking, we don't. You need to have mastery of your numbers in terms of your forecast and your unit economics. How much does it cost to acquire a customer? How much is the customer worth? And how quickly does it pay back?
Yeah.
At an earlier stage, you're still working that out, but once it's steady state, you have to just know that.
Yeah.
And one of our investors will say, we had a company come through an insurtech business a while back, and they were great founders coming out of the industry for years, having worked at an accelerator within a CVC, having launched 30 insurtechs. Now they're coming out, solving a problem, a gap in the market, and they were very good. But one of our angels asked a question, and it's hard to answer all the questions on the spot, but one of the founders kind of gave a cutesy sort of response, and it was okay. She was very charming. But afterwards, one of our angels said, they need a stronger answer next time for our full group, because it's not cute to not know that, right? So that's what we see as some risk.
Yeah.
Another one, I'll get into this now, if you don't mind, is funding risk. of subsequent financing rounds. In the UK, there's a known funding gap. The British Business Bank pegged it at about $15 billion. And the stat I use to illustrate this is potentially illustrated. It's not causality, but uh, Europe, including the UK, has half as many startups as the US, but only a fifth as many scale-ups.
Mm.
So the attrition rate, this just drops off.
Yeah.
Part of that is because not that many investors in the UK can write 10 million pound checks.
Mm.
And if you're a business that needs to raise 100 million to reach scale, pretty soon you're going to need to look outside. And there are lots of reasons why the UK market works the way it works, but UK and the European market is more risk averse than the US. And so how that manifests is if you're an R&D play, a deep J curve business, and let's say you need, if you're a medical device or even certain health tech companies, and you need several million pounds to get the data to prove the efficacy of your solution or whatnot, as long as you're getting good milestone results and showing you're superior to what's in the market, you should be okay. But there are companies that raise initial money, get co-funded by Innovate UK, and then they go off to the races, and then it may take a little longer to get some R&D breakthroughs. Then they're in a tough spot because there's some risk aversion to how many more funding rounds will we need to fund as investors, and then that company will be compared to others in that space and other companies in the portfolio to say, well, would we rather double down on this one, which we're not sure if and when it's going to have upside, or would we rather double down on one that's already got revenues and whatnot? And one of my Italian deal maker friends says it only rains where it's already wet. So follow-on funding is much easier to get from one investor than new funding.
And it's so important in terms of scaling, isn't it? If you're
Yeah.
trying to go global, it's
So
massively.
so the one of the challenges with subsequent funding round risk is the risk appetite for UK and EU investors versus say US. So as a founder, when you're looking at investors, you should be assessing what's their depth of pocket. Can they follow on? Can their network follow on? And also start earlier. I have some notes on kind of what you can do here. And there's several things you can do to try to mitigate that. And so the other thing is, so I used to say that, and I still do to a degree, but as investors, we invest in a series of discrete experiments. We want to put in X amount of money to prove out why. How much runway does it get you? How many users does it get you? How much revenue does it get you? So put in a couple hundred grand as angels, 6-12 months time, where have you gotten to with that? And then if it's either that initial investment is either a bridge or a pier, right? We put the few hundred grand in, then if it works, it's a bridge to the next round. If it doesn't work and we think that's a dead end, it's a pier, and we're done. Now, how do you get around funding risk? It's not just a deep J curve thing. It's not just a UK European thing. It's 40% harder now than it was last year to raise money, kind of in UK and globally because the IPO and exit markets have been backed up. You've got lots of. If you look at VC, they sell on to PEs. You've got lots of dry power. You've got lots of funds holding on to companies' assets that they haven't been able to sell because they don't want to take a hit on the valuation. They may be bought. They were a little undisciplined in their DD and valuation previously, and now they're holding on to wait for the market to come up. And also, there's not a lot of IPOs happening anyway.
It's slowed everything up, hasn't it?
Yeah, it slowed everything up. So, and even LPs, limited partners who feed into the funds, they're being more judicious with where they put their money. And as the markets adjust, they need to always be rebalancing their own portfolios. And they're basically some of the LPs are saying, ask your PE fund or VC fund the level of due diligence they did on the valuation side when they bought into the companies. How disciplined were they on those valuations then? Because then that'll give you a sense for what the likely returns are going to be. But anyhow, so but the point I'm making, there's another point. One of my US colleagues who in one of our other chapters made the point, in his opinion, there's only two ways to raise money right now, is what he was saying. You either raise to get to break even, you raise enough money to get to break even, or you raise enough to get to Series A. Anything else subject you to this refunding risk. Because in a SaaS business, for example, say you raise enough to get to MVP, and then you're trying to get through, you're doing a seed extension, you're trying to get Series A. If your growth rate slows to less than 10% a month, and other factors are not in your favor, you're not going to be able to raise that money at just the time you're gearing up and scaling up the team and the resources. So that's the fatal pinch in SaaS, right? So we like to know, in terms of how we do risk, how far from operational break even is the company, or if they're earlier stage, how far from revenue, all that stuff. It's a lot.
Yeah, no, absolutely. You mentioned earlier on about the deck and the the plan. I mean,
Hmm.
founders are always talking about the deck. I mean, give us your view on the deck. What do you look for in a good deck? And also the plan, the written document that goes with the deck. I mean, the deck's about presenting your ideas. The written plan is about the detail, isn't it? I mean, to give us your take on the importance of those and what do you look for in a good one and so on.
Sure. Yeah. So I'll talk about the deck first, and then I have some comments about business plans that may be a little controversial. But um, in terms of, sorry, I'm not, okay. So from my perspective, all right, let's talk about the role of the deck in the audience, right? Begin with the end in mind. So the purpose of the deck, one of the purposes of the deck is to get you the meeting with the investor.
Yeah.
So what does that mean? It should be short, simple, concise, impactful, boom, right? Because the deck is first used when you're doing an outreach email with a headline, simple, short cover letter bullet points about why we should look at this. Ideally, you've been referred in by somebody we know. Subject line is interesting. Then there's a short deck, 12 slides max, just lays out the things we talked about before, kind of what the one liner on what you do. You know, we are we are solving, we are driving better health outcomes through self-managed care, whatever. Um, if you're an app that helps people self-manage their Parkinson's symptoms, for example, whatever. But we want to know, headline level from my perspective, the contours, it's meant to get our interest and make us want to know more so then we can kind of call you and have a conversation. So give us enough information to take a view, but don't inundate us with details. Graphics are good. Bit of text is okay, but not super text heavy. So it follows a certain kind of proven flow, which I take from Sequoia because they were at the time the best VC in the world. So there's kind of a standard flow we've been conditioned to process as investors, and it's like I said, one liner. What's your company purpose? What problem are you solving? How big is it? What's your solution? Why now? What's the market size? And you can talk about market size somewhere in there. Competition. How are you solving the problem differently and better than your competitors? A bit about the product, the form factor, where you sit in the ecosystem, the business model, revenue model, how you make money, and then the team. I like to put the team a bit earlier, but and then the financials, kind of what's the deal in the offer. So those are the elements. You can sequence it how you like. But we get annoyed if the deck is missing that. So one of my bugbears, and I say this in my talks I give to founders and things, is we need to know your market size. We need to know the market size, and if you don't know it, that's not a good sign. If you have any traction, so the milestones and traction, that sort of thing, what have you achieved thus far? If you're pre-revenue, let us know, but what you've proven out. If you're post-revenue, let us know what your sales. So let us know what your revenue is. It's like pulling teeth sometimes. You talk to sometimes companies are embarrassed and actually have decent revenue, but they want to, we're only 100K ARR. It's like, that's all right. We're not judging you based on that. We're going to judge you based on how cleanly you answer the question as well. Right. So let us know the stage and what you've proven out. So at that level. Now, what I would say also is that's the initial deck, which can have an appendix. To stick to 10, 12 slides, you can have an appendix, which we can look at our leisure, but don't give us a 25, 40 slide deck. Too much. As the guy who receives a lot of the decks, dozens of decks, each site's like hundreds, too much. And VCs will tell you the same thing. So, okay, there's that. So it's what we're going to receive is a summary email, headline be referred in, the deck, and then we'll reach out to you for a call if we're interested, and then we go from there. Now, so for our process, our angel group, we have an application form and we ask questions like that. What stage are you? What makes you unique? That sort of thing. Alongside the deck, you attach the deck and then you answer our specific questions, including did anyone refer you and did you hear about us? So we take those things together and take a view on the attractiveness of the company. And in the UK, if you're EIS or SEIS eligible for those tax advantage programs, and please tell us that. And do give us we force companies in our application process, because it's also annoying to not know this, we force them to give us a directional valuation. We like to see that. I know sometimes companies like to have it negotiable, all that stuff. So in our process, we like to see it because it allows us to prioritize. And we look for our group, we look for angel-friendly valuations. And we, like I said, for a really impressive company, we'll bend that. But if you're coming in at a 50 million, 100 million valuation, it's not for us. And if you're coming in, or if we think the valuation is just not realistic based on the stage you're at, we say, time out. Yeah. I'll pause here.
And the
That's
role of the business plan as
yeah.
distinct from the deck. What are your
Yeah,
thoughts on that? I mean, people have very different views on the plan.
yeah. So in angel and VC land, things have moved on kind of in the last, I don't know, in recent years. Like, okay, let me say this. Let me preface my comments by saying this. I'm going to quote one of the old generals who said, plans are useless, planning is essential. Okay. I like companies to go through a business planning exercise to get their team all on the same page in terms of how we're going to achieve the targets and the goal. In practice now, for in the venture space, your financial model is your business plan in practice. It renders all the assumptions and the approach you're going to take into a model that we can interrogate and do sensitivity analysis on. So that's actually the de facto business plan now. But to do a really good model, you need to have covered, you need to understand your market, the dynamics at play, and how you're going to capture that and all that. So you need to do that. You need to think it through. You can capture it in a summary way. And later on, let's say if you're doing a subsequent bigger round, if you're doing an investment memorandum or business plan, whatever, you can pull together more detail then. But for early stage, pre-seed, seed, even going up towards Series A, VCs are not going to read a bunch of business plans when they're screening. And what they're going to do is they're going to open an email that was referred to them by someone they know and trust, who's going to pre-pitch it for them. Like, this is interesting. You said, look at this. They're going to look at the deck. If it's for them, then they're going to reach out to the founder and get a call and then start doing their own DD. So in practice, the document itself is less important than it used to be. The exercise and the thinking is still just as important. And then the fact that the capability to render it in a financial model that we're going to use to interrogate your approach is super important.
Yeah, I agree with you about that. I think the important thing though about writing it down is not necessarily whether you wave it in front of other people when you've written it down, but the process of writing it down and capturing it enables you to think it through in more detail. That seems to me to be the most powerful part, so that you've got the thinking clear as a result of doing that work, isn't it? It's like most things in life. I mean, you know, you have to do the legwork
Yeah.
to get it right, I often think. So thank you.
Crystallizes your thinking.
Yeah,
And,
that's the
and,
right way to put it. Yeah.
and
And the other thing you touched on was the role of the investment committee. I mean, a lot of
yeah,
people don't understand how that works. I mean, just talk us through that.
yeah. So headlines. So I chair our deal screening committee, which is for us is kind of like a de facto investment committee to determine the deals we're going to look to invest in. So the way that we use it is in a couple ways. Several heads, we got 10 or 12, depending on who's available, are better than one. So we use it because we're sector agnostic as an angel group. We've got people on our committee. We've got Amazon people who screen our e-commerce deal flow. We've got medical doctors who screen some of the deep tech medical stuff. We've got lots of PE investment bankers and others who screen and do M&A and buy and sell these sorts of companies that, like, these companies may in 3 to 5 years be a company that they're going to work with, and or they know the buyer's minds really well. So we have all those perspectives. So it helps us really assess the company. It also helps us balance out our own biases, because sometimes when we're screening, we do one-to-one screening with companies and then we bring them to committee. Sometimes you fall in love with the founder, right? You say, oh, this is great, and we get emotional about it. We want to invest. We want to back them for this, that reason. We had recently one company that was super impressive. And then when our committee member was kind of advocating and talking about them, we said, okay, great. So we've heard all the pros. Are there any cons? What are the cons? And the only one of the cons that particular screener saw was, the only thing is this founder exited before. He founded and exited previously, and he exited after a few years. So one question is, how long is he going to stay with this business? Is he going to exit in a couple of years? So we support and challenge each other to kind of cover our blind spots.
Yeah.
And have it. And we're also, we've got diversity of thought, experience, gender, ethnic background, all of that. But we need to geographically as well, because if companies want to seize and serve markets in Africa, we actually now have 2 people on the committee they're both from South Africa, but so we've got coverage there and other places, which there's no substitute for that. And I've lived and worked in the US and the UK and Germany. We've got similarly other people on the committee who have that global sort of experience. It really helps as a check. And frankly, we all learn from each other, and we're able to give that much better feedback and steer to the companies as well.
Yeah.
And frankly, it helps us we like to be as intelligent of a filter as we can be for a wider angel group, so that they have to do a little so that we've already kind of shortened the process for them to be able to get involved and deploy.
It strikes me that it's rather like writing the business plan. It sharpens your thinking. I mean, having the investment committee sharpens your thinking, doesn't it, and protects you from doing
Yeah,
stupid things. So yeah, no, I totally get the logic of that.
yeah.
I'm not sure. I'm not
Oh,
sure a lot of entrepreneurs understand that, but I totally understand that.
sorry, Paul. Okay. Well, the other thing I would add there is there's the emotional thing, and then there's that value of having the checklist. It's like, okay, there's the emotional side we want to get involved in. Okay, let's make the checklist of what we need, and I've got my 5+1. We've got 7 questionnaires. So I've kind of, it's a summary of more or less what I talked about, but so that we're making sure. It's like, ooh, do you know what? We didn't check on this, or we didn't check on that, or actually, what is that growth rate, or what's the unit economics for this particular thing? We've had companies come in. The other thing is to get more eyes to spot something. We had a company come in a couple years ago, pitched pretty well in an area that I had happened to have operator experience a couple years before. So they came through and they were pre-screened by someone else who had a committee meeting. They did pretty well. And then we asked them a question. They were talking about their revenues, right? And sometimes, and this is a challenge I would say to founders, be as ambitious as you can be that you think can deliver in your projections. However, when you're talking about actuals, make sure you frame things in a way. It's like my approach at CVs: claim as much as you possibly can, but no further, no more.
Yeah.
So this company came in and they pitched and they talked about revenue. They had, I forget what they called the sort of revenue. And I said, I'm just curious. You said you had 50 customers, but this type of revenue you mentioned was really, really high. I said, where's that come from? Oh, it turns out what they claimed was, as their headline revenue was, not just revenue to existing customers, expected follow-on revenue from products and services that hadn't even launched yet to those customers was being portrayed as top-line revenue. I was like, no. If that's in your forecast, you can talk about it a certain way, but don't try to pull the wool over our eyes. We asked that question. And I asked another question. I said, look, just full disclosure, I have some hands-on experience in this industry. I've got some tough questions for you. Just unpack that revenue number for me and how you're actually automating this particular regulated procedure in such a way while saying you're not actually regulated. So we will get into it, and we will call. We're not there to play gotcha. However, if something doesn't smell right, we will probe. And what I love is when the tougher the questions get, the stronger and better the answers get. We like that. Because that means maybe the founder was just having a moment, or they're a technical founder and they're still getting up to speed on sales. Whereas the more we probe, if it crumbles, you're done.
Yeah, yeah, no, absolutely. Is that attention to detail, isn't it, really? One final thing, because you've covered, I mean, it's a really interesting model that you've got there, and you know, yeah, fascinating to hear you talk about it. Just tell us about the way you've developed it, because you haven't sort of just plucked it out of the air, have you? I mean, you've been working on this for a while. I mean, give us a flavour of how you know this is robust.
Right. Oh, sorry. The one thing I didn't cover the +1 and impact in terms of what I look for there. I gave a headline on what I look for there, so I will answer that question. I want to just mention that part too. In terms of what we like to see for impact, like I said, is a company that generally has a positive net impact on people, planet, and our prosperity. That doesn't mean they're dark green and that's all they do. It just means they've thought through the effect of their company on the environment and society, and the effect of society and environment on their company, and that sort of, and vice versa. And if they haven't done that, or if they're trying to do the overclaiming or greenwashing and all that stuff, because me having worked in that space for a long time, you could just kind of sense it. So true impact, great, versus those just trying to claim it, like, oh, we've got a data business, and now we're gonna plug in carbon climate data as part of that. Okay, that's fine to do that. You're credible to deliver that, but if you tell me that we're just doing it as a money grab and we don't really believe in it, like, we're not going to invest in you, right?
Yeah.
So maybe less likely to invest in you depending on that. But in terms of how I developed it, so this model, I've worked with loads of, I might have raised a lot of money myself. I work with loads of other corporate finance houses, investment bankers, PE players, and things like that. And I just kind of pulled together, combined some different models, and I changed the sequence of certain things. What I saw, like, I didn't invent the idea of proof of concept, growing markets and all that. But to me, this seemed to be, this combined approach seemed to be something that captures most of the areas without being oversimplified. And then it's personalized with me for the impact space. So for example, if I need to go simpler, I'll use Peter Thiel, which is, we look at the team, the tech, and the business strategy. We ask questions about that, and whichever one we hear the least about is where we probe the most. But what I don't like about that model is that it doesn't include explicitly the now. So one of my PE folks says it's the timing, the team, and the thesis. Right idea, wrong time, you get pain. So you need to have the timing right there and the team. And what's the thesis? What are you actually betting on this company to be able to do? So yeah, it's just through my it's been kind of through my experience in the market. It's been kind of road tested, battle tested with entrepreneurs and other funders and investors. And for me, I use it because we get pitched dozens of companies. If 12 or 15 companies are going to be talking to us, I'll just make a grid on my sheet and I'll just put my 5+1 in there and I'll give it tick marks or a quick score in each area. So then I have a tally at the end and I'm comparing apples to apples, just like during job interviews, you want to ask similar questions of similar candidates so you get a fair view. Otherwise, you can go down a rabbit hole if somebody pitches and you only ask questions about a certain area here and different area there. You actually don't have a common basis to make an assessment.
Yeah.
So that's kind of it's
Yeah.
been developed in the trenches, or coupled together from the trenches. I would say I borrowed liberally from my colleagues and those in the industry, and this is what I landed on that I think is a useful shorthand. 5+1 you can remember. Anything more 7, 8, 10 is too much.
Yeah, and that's what I like about it. It's relatively simple. It's relatively comprehensive, simple, and it's memorable, and it's something that it strikes me as manageable. So I mean, that's the thing I like about it. I've heard of lots of different approaches, but the thing I like about yours is that it's got those things. It's simple, comprehensive, but it's manageable, which is really important when you're trying to make decisions reasonably quickly, isn't it? You need to have a manageable system. It's easier said than done getting those decisions right. So having a system like that's very helpful. So Carl, thank you for taking the time to talk people through that. I know other founders watching this will find that useful. It will help their thinking about how to approach investors and how to put together a deck and how to think about their business plan and the strategy that they're developing and so on. So thank you for taking time to share that. I'm sure it will be very helpful to people, and I really appreciate your time. Much appreciated.
Sure. Shall I just tell people on my LinkedIn if they want to kind of follow or keep in touch with our different events
Yeah,
or
yeah,
anything like that? So
yeah.
yeah, so it's just my name. It's KARL-REGO. You can find me on LinkedIn and then other places as well. But if you want to see where events we have or talks, or I post occasionally, I'm not super active on there now, other than some of my investment activities. But it's useful. I always love to hear from founders and anyone else interested to have a chat.
Yeah, and if people want to contact me, I'm happy to connect you up. No problem. So, Carl, like I said, thank you very much. Much appreciated. Very helpful.
Thank you. Take care.
Cheers, Carl. Bye bye.
Bye bye.